Welcome to SharkCapTable LITE. We're going to do one round of equity and royalty financing. We're going to get into the real details of how to structure a deal. And to keep it within the time limit, we're going to go over some things very quickly. And this is, of course, where you make a deal to keep your arms and legs. Okay, we're going to show the help. We're going to make these investors sharks. You already know that if you spin this, you can get some interesting help. Now here, I've gone ahead and put in 3 different founder investments with the shares. We've dialed in $20,000 as a founder cash call. Now the idea is that let's say you come down here and you zero this out. You still have these same numbers here. Let's say you go to an investor, he says, you know, you guys just don't have enough money in the deal. I'd like to see some more skin in the game. So you say, okay, what would happen if we came back with another, say, $25,000? He says, okay, that's much more interesting. So that's what we call as a founder cash call. What's going to happen a little later is this $25,000 is going to be apportioned by the ownership, so that these guys will have 25%, they will have this ratio. Now, we've got to ask ourselves, how would we like to price it? The weighted average of these 3 is probably a good one. You could do the maximum, which would be 13 cents. You can see it there. You could do the average, which would be 11. You can see that there's no number in there, so that's the average. Let's do it at the max, which happens to be the latest one, which is usually what will happen. Okay, so we have a few options here. We add them all together. They come in here on the yellow line. All right. You already know you got to put in at least a 15% option pool. Now, just to review, here's the founders lines 1 through 5. That's the $17,000 that we had up here. This is the $25,000 you had here. And we have put in a valuation, just to make a founder's valuation of $500,000. So here's the total detailed founder's valuation. You can come over here and you could see up here where our $500,000 comes from. We've already got the 42 added up, so we don't want to double count. The program doesn't allow you to double count. And by the way, we will get into the fact that we have other methodologies. Here we have a summary of the different types that you could be using, and we give you 3 of the 4. We give you the venture capital method, which is sort of how we do it. We kind of do the Dave Burkus method. The risk factor summation method is a really nice one. And Bill Payne, a terrific angel with a great site. Go see him. Smart man, good guy. And he's got the scorecard method. I would suggest if you want to use the scorecard method that you download his white paper and follow it. It's a little more complex than I wanted to do in these sections here. All you got to do is just, dial in a number here, investment, so forth and so on, and and you can see that this multiple, as the multiple gets bigger, your pre-money goes down. So the question is, how do you solve for a positive number? Well, you just keep cranking some numbers in, but the investment shouldn't go up. It's the exit value that has to go up in order to get something realistic. I'm going to zero this because I don't want to use it right now. Same thing goes for the Dave Burkus method. Here he basically says we've got 5 of these components. Give it something between 0 and $500,000. It sounds very similar to what we have. We have a little more detail. Then down here is the risk summation method. Basically, a large number, which is 1 or 2, indicates lower risk. It sounds a little bit backwards, but I can understand how these gentlemen put it together. So you just come in here, you can dial up 2, 1, 0, -1 or 2, and you can just go through here. And I've written up some of my examples of what I think they're talking about. It's just my opinion. And you'll end up getting, I think 250 is the correct number. So now you've got a 1.5. Well, maybe you got to make this couple of positives here, and suddenly you got $500,000. Play with this to see how it works. And then again, this is the Bill Payne scorecard method. Okay, so just to review, you've got several ways that you can do a detailed founder valuation, and you can compare and contrast them simply by looking at this summary. See, we've got Bill Payne's angel valuation, which is an average, And you can change those over here if you want to, if you get some later numbers. This is ours right here. And apparently we have a risk factor summation method in there, so we're going to come back here and just go down here and zero that out. So now we're back to not having any of these. Great. That's what we want. Okay, so let's go back to LITE. That was a quickie. All right, so here's where we left off. The total detailed founder's valuation. If we had anything coming from that other sheet, the other methods, you'd see it. Right now it says angel average is 1.67 million. You saw that in the average of 0 valuation methodologies. If we use 2, it would say 2 valuation methodologies, and it would give you the average right there. And then you can kind of compare the average with ours and the angels and come up to some kind of an average that you would be willing as an investor to ascribe to our little company. All right, so dial in whatever it's going to be. Let's be nice and give us $500,000. We're looking for $300,000. Post money is $800. Great. All right, moving right along. Now, we have already placed into this the gross revenues as a projection. You know that you can spin this and you can actually be selling in year 4. This 2 is 2 times the revenues, and this is the valuation that we're going to get, $2 million. And since this looks like a 37% deal based upon our pre-money, investors or sharks are going to get $750,000. If we put in some EBITDA, earnings before interest, taxes, depreciation, and amortization, we would end up having a fairly large multiple. But keep in mind, if you move it forward one, now you've got a very reasonable sales multiple, and basically 6.7 isn't bad. So this is kind of known in the industry as trailing. Click it one forward, and you can kind of see that that's okay. But let's make a sale in year 4 to improve the internal rates of return, which of course are time sensitive. Earlier is almost always better than later, unless the company grows super fast. And it's fun to see what happens with different growth rates. Play around with them. It's very valuable. Okay, so here we are. We've got our equity deal, and here are the numbers. There's $300,000 in equity investment, shares issued, price per share, pre-money valuation, exit year. Shark share is $750,000, which is 37.5% of the $2 million exit. And sure enough, there it is. Double checking. Total return, we haven't added anything yet. The I multiple of 250. Shark IRR at 25.72, and the ownership stake is 37.5%. Now the next thing we need to do is we need to record these numbers by just dropping the drop-down box and selecting the number, which is the one immediately to the left. We need this to maintain a static capability so that we can see what happens. We're going to go in here and we're going to select a combo. Now when you see red, you have to do something. So that tells you we've either got to choose a gross sales or a preferential. Let's do preferential. A preferential royalty is attached to the deal and has 0 cost. You can read about this over here. It has a limited life. It's preferable than doing a royalty forever. The return is understood, and if it gets sold before the return is returned, then they get all their money back plus the expected return. So notice that there is no cost. It is something we're going to attach or add. Here it says spin in preferential royalty. Well, let's make it about a 5% on sales. Royalty begins year 1. Set in a minimum base return. This is kind of like a base number. Just put a number in there, and then we're going to multiply it. You could put a big multiplier with a small number or vice versa, but let's go to 3. 3 times 70 is $210,000 of extra revenue that is going to come by virtue of a combo preferential deal. Now, that gives us a little higher rate of return. In fact, it's quite a bit better return. There's the 37.49. Now, the supposition is that if the investors liked this deal over here, then they're certainly going to love this deal here, especially if they have the same ownership stake. But I'm going to propose that they would like something like 26%, so I'm going to increase this until we get down to about 26. I'm going to fine-tune it until we hit just 26. And that's pretty good. So that's a slightly better rate of return, but by virtue of increasing the pre-money value, we have decreased the ownership stake. That's good for us guys over here because we might have to give away some shares in the future to get another round, and we don't want to give up control of the company so early. So this is the great advantage of a combo preferential royalty. Everybody likes them. It's a new way of doing business, and if you want to see the details, come on down here. It tells you why, preferential costs, there's some calculations that are active, the profit at the exit, not a big profit, but you maintain control longer, which is worth a lot. It's also risk mitigation. Investors get a little bit of money going in, and that's pretty good. Non-voting issues, well, preferentials allow you to increase the return and reduce ownership back to the acceptable pre-preferential level. Do not solve control issues with non-voting shares, at least at this level. Investors like to participate and will avoid your non-voting share opportunity. Let's go back and I'll show you another one which is interesting, and that is you could do just a pure royalty. So let's come in here and do a royalty deal. Now sometimes you see this on Shark Tank. Let's do a payback royalty, okay? Now here we need to spin in the investment. So let's put in the $300,000 because that's what we need. Takes a little bit of doing, but here it comes. $300,000. We're going to spin to exceed this royalty here. See, if we got it the same, that wouldn't be it because you have to have a little bit bigger royalty than the payback royalty, which is afterwards. So make it 5.5. Let's make it 10. That's what Mr. Wonderful does. He always does 10 to get the 300 back or the 100 back, and then 5% thereafter, starting year one. We need to zero this base. See, just follow the red. When you see red do something, it says zero this multiplier, do it again. There we are. So we're just kind of crumbing on down, and there we are. Okay, we're going to get back in these 4 years $300,000. And the reason is that we got this payback. It's going to pay back from the sale. Watch what happens if we go up here to something like a year 7. We're going to get a little bit more money because we've got this 5% after payback. But you see, when you're down here, you're selling early, you just get the payback. The 5% is in there too, but it doesn't continue when you sell the business. So that's very interesting. Good to watch up here and see what happens. Let's go to a royalty deal, a preferential. So now it says you still got to buy it because a royalty deal raises the money. You want to zero this. And we got a preferential royalty rate of 1. Spin in the investment return. Make that about a 3. And there it is. If he puts in 300, 3 times that is 900. Now, the internal rate of return is pretty good for a short period of time. Let's go out a little bit more. And you can see that actually it gets worse through time because you're getting some big royalty payments, but you got to wait 7 years to get them. So I've maintained sometimes that selling early, especially with a preferential royalty, is a pretty good deal. Now, unfortunately, your EBITDA after these royalties goes all to heck, so maybe that won't work. Maybe you have to do a, year 4. But of course, your EBITDA after royalties, if you're going to sell, it all comes out in the wash anyway. These pink numbers are really just in case you have something like this at the very beginning. You've got a negative number of EBITDA, but you still have enough cash, so you're okay there. The cash would go to negative number here, but you'd be selling, so it'll all work out. Sale proceeds are used to settle these royalties. And of course, you could do one more here. You could do the gross sales royalty. Here we don't have any preferentials, so we zero it out. And then you'll see an interesting thing. Watch what happens when we go out to year 7. You see it just stays on forever. And it ends whenever you sell. So there's year 3. Not a very good rate of return. In fact, it's negative 52. So that's why a preferential could be so much better, because they'd get a big lump right there, and everybody's happy. You sold the company, and the royalty guys who gave you the money without demanding voting control or voting interests, you're in. So, to review, This is a very powerful section of the model. You can do royalty deals where there are three types of royalties: gross sales, which goes on until you sell, but it doesn't guarantee a payback, and you can read about it over here. And by the way, if you don't want to see that, you can come up here to the show help and hide the help. But this information is so important that I would suggest that you do, for the time being, show the help, and then you can understand exactly what's going on. There's very specific definitions. Don't get freaked out. It's not hard. Just play the game and look at what you're getting up here, and you'll get the whole picture, and you will be a great deal maker. So much better than anybody else. And by the way, come down here and read what's going on. There's an analysis that happens here, some calculations. You saw that in the combo, and they are available in a lesser extent in the royalties on Section D. Very powerful. Thank you very much.